Good afternoon. We are the Ohio State University. My name is Amy Lei. They are my teammates, Michael Ning, Ford Allen, Ryan Tao, and Annie Swan. Today, we issue a hold recommendation on Cintas. Our target price is $72.23. The current price is at the high end of our valuation range. We believe Cintas has performed really well relative to the S&P 500 over the past 5 years, as we showed in this graph. We identified the most important drivers for Cintas growth are share repurchase, strategic acquisitions, and spin-offs. Over the past 5 years, Cintas has spent $1.4 million on share repurchase and $350 million on cash acquisitions. Last year, Cintas spun off the document destruction business for $180 million. At this stage, our main concern is that both the valuation for both potential acquisition targets and the current stock price are relatively high. Therefore, we expect both activities to slowing down going forward. The other concern we have is on the margin of the first aid and safety division. We identified this division as having high growth potential. However, its margin is substantially lower than the core uniform business. Taking all factors into consideration, we issued a hold recommendation on Cintas going forward. Cintas' history can be traced back to 1929. Its current CEO, Richard T. Farmer, is a descendant of the founder. Today, Cintas provides various products and services with 77% of the revenue coming from the uniform rental business. Cintas is the largest uniform rental company in the United States with 25% market share, more than double of any other three main competitors. With that, I will move on to Michael for the competitor analysis.
Thanks, Amy. Cintas has dominated its three main competitors, UniFirst, G&K, and Aramark, in revenue, net income, ROE, and stock return. While Aramark is the second largest player in uniform rental, UniFirst has the fastest revenue growth rate and second highest net income and margin. And the stable gross margin shows that there is no fierce price competition over the past 5 years. We believe this industry has significant economies of scale. As the largest player, Cintas maintains a 14.2% of operating margin compared to its peers' 11.7%. This advantage can also be observed through Cintas' revenue per employee, which is 19% higher than its peers. With a forecast GDP growth at 2.8%, the US economy is recovering. However, if we deduct the GDP growth rate from non-uniform using industry, the GDP growth will be at a mere 1.3%, which is well below the 2.2 overall. And also, the uniform rental industry's clientele also face a slower job creation, which is 1.5% versus the 1.9% overall. The falling commodity price helped improve the industry's margin. Fuel costs, which is estimated to be 1.7 to 2.5%, and cotton cost is estimated to be 2 to 3% of industry's revenue. As the commodity price falls, we believe this can help improve Cintas' margin by 1%. Now, Ford will talk about the financial analysis.
Thank you, Michael. As the US economy recovers, we expect uniform rental and direct sales to grow at 5% and 3% respectively. We expect further penetration into the fire and safety segment for Cintas, where we expect growth of 9 to 11% for the next 5 years. We also incorporated cash flows from the document management spin-off. We use pure play companies in the document management industry to estimate cash flows using dividend yields and dividend growth rates. However, we do not expect cash flows to start coming in before 2016. As Michael mentioned, the falling commodity prices will lead to improvements in cost of goods sold margins of 160 basis points for the next 2 years. We also expect increases in efficiency due to economies of scale in the form of falling net PP&E to revenue ratios. However, for this year, there will be CapEx of $260 million due to the implementation of the SAP system. We also estimate that Cintas will have adequate debt capacity to finance all its capital expenditure. Cintas is the industry leader with a superior ROE. This is mainly driven with the 2.5% superior net income margin compared to all its peers. As we go forward, we expect that Cintas will have increasing EPS. However, return on assets will not be increasing at the same rate due to greater accumulation of cash reserves. With that, I will move on to valuation with Brian.
Thanks, Fuad. We calculate our WACC by using CAPM to calculate the cost of equity. Cost of equity of 8.55% is calculated by using long-run average treasury rate as our risk-free rate instead of T-bill rate, which is currently near zero. And finally, from the breakdown of the WACC, you can see we estimate our cost of capital to be 7.82%. We incorporate several considerations in our terminal growth rate calculation, characteristic of company, industry, as well as macroeconomic factor give us a terminal growth rate of 3.5%. Combined with the former projection and discussion in the financial analysis part, we come up with an estimated DCF value to be 75.46. For relative valuation, we select G&K Services and UniFirst as our peer firm for Cintas. By using the price multiples and enterprise value multiples, we come up with a price range of 51.26 to 67.41, as well as the target price of 59.33. Finally, our target price is a weighted average of DCF valuation model and relative valuation model. We gave 80% to DCF valuation and 20% to relative valuation, since there are just two peer firms for the relative valuation. We exclude the dividends growth model due to the distortionary effect of high-level share repurchase and special dividends of Cintas. And finally, we got our target price to be 72.23. And then I'll pass to Alice to talk more about the investment risk.
Thank you, Roy. Let's move to risk analysis. First, acquisition risk. Acquisition risk influences its strategic decisions. Since the greater market saturation and its competitors playing the same strategy, and there is a trend of slowing down in cash acquisitions. And also, acquisition strategies may not be as feasible and may not be cost efficient in the future, since the price per earning to Cintas and its competitors increased from 70.04 to 28.46, which implies that the valuations for Cintas' potential targets were also increasing. Second, macroeconomic risk influences its share price. By doing the regression analysis, we found that the correlation between Cintas and S&P 500 index is 0.76, which is higher than its competitors. And there is a lag between Cintas and macroeconomic changes due to its ability to have the long-term contract with its clients. Next, Fuad will talk about Monte Carlo simulation.
Thank you, Alice. Taking all the risk factors into consideration, we built a Monte Carlo simulation where we find a price range of $66 to $82. In the Monte Carlo simulation, we also found that the valuation is most sensitive to the WACC and the terminal growth rate, so we ran a separate sensitivity table for it. The valuation range that this sensitivity provides is also very similar. Now, taking all the macroeconomic, industry, and the farm-specific factors into consideration, we find that the current price of Cintas at $81 is within our valuation range, and we issue a hold for it. Thank you.
Time. Man, right ahead, guys. Good job.
Any questions, please?
Just a couple of questions. Any reason, well, just kind of high level, you have a hold. Due to your analysis, any reason why you would be short a name? Is there one trigger that would turn you to go the other way, actually be severely negative? Because it looks like your 12-month target is well below the current price.
Well, with any, if we see that the price goes beyond our range without any changes in fundamentals, that would obviously be a trigger for recommending a sell. But any changes in fundamentals, especially changes in macroeconomic factors, because Cintas is so heavily tied with the US economy, because it's not diversified internationally, and it's really with our regression analysis, we found that it is really tied with the S&P and also with GDP and unemployment rates. So we would assume that any negative shock to the US economy would be a factor that would recommend us selling.
With regards to free cash flow, did you build in acquisitions into the way you were thinking about the valuation and the growth of the company or not? I'm assuming you didn't. That led to the cash flow building up. If the company were to make some acquisitions, do you think at current rates, would that be accretive or not value added to the story?
We believe that as the market price move higher, it will create less value for Cintas to acquire a company at this stage. Actually, for Cintas, they have a really good discipline in both acquisition and the share buyback. For instance, the fiscal year 2015, they have less share buyback and acquisition going on.
It's actually evidence. When we do the research, we saw lots of merger acquisition when there's economy slowing down in the financial crisis. So their strategy is to acquire some company when there's a slowing down of the economy, and when the economy is extending to recovery, they also take advantage of this recovery to do their internal growth to support their earnings and revenues.
I would like to add to that. The growing cash reserves would mainly, in our model, mainly result from us not taking into account any share buybacks. We do assume that the farm will be growing, and it would obviously have some acquisitions in that growth, but we do not assume any share buybacks because it's a very unpredictable thing to model. That's why we have increasing cash reserves.
Kind of on the same question in terms of acquisitions. Would you foresee them spending just their cash down, or using their stock as a currency in buying somebody?
As we see that the stock is nearly at the top of the valuation range right now, it's a better currency for acquisition. So as we go forward, we would expect more acquisitions financed through stocks.
Another one, in terms of, you have a chart here on oil and just the relationship and the impact on revenue. Did you factor in the current drop in oil prices going forward at the current lows, or did you take an average, or how did that impact your valuation?
We used the past calendar years average and the past 2 months average to compare to as a basis to forecast the impact.
Gotcha. And do you know, did you look in to see if they hedge at all in terms of the derivatives contracts?
They do hedge for their foreign currency exposures, but only 10% of their trade is done internationally, so it's not that big of a hedging.
Okay. Do they hedge on the oil at all?
We didn't see that in their 10K.
So on the multiple evaluation, in your target price, you can take them down to the average, to the mean. And do you think there's any reasons why they might trade to a premium to the group, given or underlying fundamentals?
Yes, from our company-specific analysis, we saw, and also financial analysis, we saw lots of advantage of Cintas, because Cintas have a higher profitability and a higher scale. That means Cintas can take large advantage of economic scale, because from our research, the uniform industry and sector, if you want to win this game, you want to take the largest scale of economy. So from our perspective, we think even Cintas have like higher multiples than the other peer firm. I think we think that is reasonable.
Also, we identified in the DuPont analysis that Cintas definitely has a higher ROE compared to all its peers. So we think that that's also another factor for higher share prices.
Kind of on the same question, did you guys strip out the different segments of their competitors, or did you just look at it as an entire company?
Yeah, we have different in the valuation model, especially in the DCF, we have separate as different segments. So we predict the growth rate in different segments. That's why we mentioned like the first aid and safety division is identified in our model as having high growth potential. However, our concern is that its margin is substantially lower than the uniform core uniform business. So we do have different segments in the model.
With the multiple valuation, the reason why we took only 2 firms out of the main 3 uniform producing firms is that the third firm had 80% of its revenues from non-uniform section industry. So the other 2 firms, UniFirst and GK, are almost pure plays in uniform rental and direct sales. So we just took their multiples.
Yes. In addition for that, we believe these 2 peers we are using are not perfect comparisons for Cintas, because Cintas have so many different businesses going on. Cintas is the largest uniform rental company. So that's why we take only 20% on these multiples. They are not perfect, but they are the best competitors, peers we can find out.
The company you mentioned had done some divestitures of businesses. Do you think that was the right strategic move?
Yeah.
I mean, and could you think about that? Could you address that from both kind of a short-term and maybe a more longer-term perspective on a divestiture of the shredding and document saving business?
I do believe this is the right strategy, because when this business within segment is not performing well, it shows a trend of slowing down. Then if you spin off, it's good at least for your EPS earnings.
From a short-term basis.
Yes, from a short-term basis.
From a stronger-term basis, part of the rationale, I believe, was leveraging existing distribution. So you're saying they can't leverage their existing distribution with other businesses, or this is maybe the wrong business to try to do?
Well, document management in general, because of digitalization and everything, we do not expect document management to be a very big business in the future anyway. So in the longer term, of course, in the shorter term, Cintas had weaker margins and weaker growth rates in the document management, but we do not expect that document management would have very high margins going forward. So in the long term, I think this is a very good decision.
Go back to the analysis. So you've talked about this several times, but only using 2 peers. Did you think about expanding that? I think other people talk about it, breaking it into some of the parts of the company, or look at it that way, or other industries. Maybe it's a little bit wider net, so that because you're right now doing 20% of something that could potentially be a higher number if you expanded your horizon a little bit. Is that something that you looked at, or maybe look internationally, or there's other companies that are maybe have a part of the business and see what those multiples are? Did you look at that, or?
Yes, we did. In our initial multiple models, we did take into consideration competitors of Cintas in all the different segments, but most of these competitors were highly diversified, and we felt that the multiples would not really be compatible with Cintas because they're very, like, Cintas is not that well diversified. Only around 15% of its revenues come from non-uniform segment. So we do not believe that taking a well-diversified firm and comparing it with Cintas would be very reasonable.
But we do put the document management's largest player, Iron Mountain, as a proxy for the 42% minority share in their remaining stake.
And that company is a public traded company, so we got lots of information.
Ohio State, thank you so much.
Thank you.
Thank you.
Thank you very much.